All right, so welcome to Learning Objective 5. In Chapter 5, we're going to be ending our introduction to cost, volume, profit by looking at a couple of things. So this idea of a margin of safety is relatively important. So we're going to be looking at this. But we also know that a lot of companies want to target their profitability. They want to have a goal. This is going to be our profit this month, this quarter, this year. And what helps managers help get them to that point is, in order to be guaranteed a certain profit, they have to know how much sales are required to get there. Okay. And so oftentimes there's a huge connection in setting of the goal that's profit-based, and then going and telling your sales force, this is your quota. You have to do this, you have to do that, because they know exactly what they're looking for sales and profitability. So they've got all this stuff worked out ahead of time, which is good. Really, really good. So target net income, what level of sales are necessary in order to achieve a certain level of profitability. It can be expressed either, again, mathematical formula, contribution margin. There is a graph. Again, I'm not going to emphasize too much that, but certainly you're going to need to do one of those two. And it can be expressed either in units or in dollars. Okay. So the mathematical formula here, we're on the bottom of page 199. Oops, I must have clicked. Sorry about that. So here, in order to understand how to get our targeted net income, we're going to be looking for our required sales. Of course, we subtract out variable costs, subtract out our fixed costs, and that gets us our target net income, which is the same as a profit, right? So companies are always wondering how to do all of that. And so in this case here, we first started by using the mathematical formula to calculate the break-even point. We simply include, in this case, instead of break-evening to zero, we put a target income in here. So instead of it being zero, which is what we did at break-even analysis, we simply put the number here of the profit that we want for that period of time. But it's set up in the exact same way. So again, this is the exact same company. They're selling their camcorder thingy-majiggies for $500 each. They have $300 each in variable costs, and their total fixed costs are $200,000. But now they want a profit of $120,000. Okay. So when we calculate this out, you still got 200Q on this side, right? By combining these, you'll have 200Q. And on this side, you will have, well, you'll add 200,000 each, to get rid of this piece. So on this side, you'll have basically $320,000. And you're going to divide that by the contribution margin per unit, which is $200 per unit, the difference between these two. So Q, quantity, will equal our 320,000 divided by 200. And that will give us 1,600 units to sell if we want this profit, Okay. So in order to meet the profit goals we want with the contribution margin that we have, we're going to have to sell 1,600 units. Okay, so this is in units. So that's how this particular technique works for units. As you also know, you can do this in dollars. In dollars, it's different because we're dividing our fixed costs and target net income by the ratio, contribution margin ratio, which is still 40% for this company. But now we have $320,000 in costs and income to cover on a 40% contribution margin ratio, which means we're going to have to sell $800,000 worth of these camcorders in order to get this particular net profit margin that we want. And again, hate to be graphic with you, but in this case here, we're looking at $800,000 of sales, which would mean roughly, and my lines are a little bit off, 1,600 units being sold. And all of this is that $120,000 profit that they want. More. Okay, so let's go to the next topic here, which is called the margin of safety. The margin of safety. We also call it a cushion. Okay, it's a cushion because at a certain level of sales, we have somewhat of a guaranteed profit. And so margin of safety, as I say, the difference between the actual or expected sales and the sales at the break-even point. So that difference is the margin of safety. We also call it a cushion. Okay, it can be expressed in dollar amount, or it can be expressed as a ratio. So let's assume our actual and expected sales are 750. Well, for this company, we had a break-even point of $500,000. We're assuming sales of 750, which means our margin of safety in dollars is $250,000. Okay. In terms of percentage, again, we're assuming a few things. But if we create percentages, we can also calculate this in percentage as well. Whoops. Computed by dividing the margin of safety by the actual. Yeah. Okay. All right. So you can actually do this as well by percentage. It's a simple type of thing. So Marshall Company had sales of $600,000. And their break-even point was $420. So what's the margin of safety ratio? Well, it's $180,000 in dollars, right? But 180,000 divided by the sales of 600,000 would give you a safety margin of 30%. Margin of safety, rather, 30% as a ratio. Okay. So the difference between your sales, your actual sales, and your break-even sales divided into your actual sales will give you the percentage. Okay. All right. I actually like the stories in this book a little better than the ones in financial accounting. I don't know why. Maybe because I just find it interesting. But here is, how a Rolling Stones tour make money. Okay, how they make money. Consider how the promoter for the Rolling Stones tour used the break-even point and margin of safety. For example, say one outdoor show should bring 70,000 individuals for a gross of $2.45 million. The promoter guarantees $1.2 million to the Rolling Stones. In addition, 20% of the gross goes to the stadium in which the performance is staged. add another 400,000 for other expenses, like the ticket takers, the parking attendants, advertising, and so on. The promoter also shares in the sale of t-shirts, memorabilia, um, for which the promoter will net over $7 million during the tour. From a successful Rolling Stones tour, the promoter could make $35 million. So again, you can look at all these numbers if you wanted to calculate the amount of sales dollars to break even for Rolling Stones concert. But this is basically how it would work for this. We'd be using all of those methods to calculate, in this case, what the break even analysis would be and what the margin of safety would be, et cetera. All right, so let's finish it up with a do it exercise review. If you have your book handy, which I really hope that you do, this is on page 202. Okay, page 202. Zoot Suit or Zoot Suit makes travel bags that sell for $56 each. Management expects the fixed costs to be $320. Variable costs are $42. That's high, $42 per unit, and you can only sell it for $56. That's very, very high. So compute the following: what is the break-even point in dollars using the contribution margin ratio? B, compute the margin of safety and margin of safety ratio if the sales were $1,382,400. And C, compute the sales dollars required to earn a profit of $410,000. So of course, one thing at a time. So the first thing that we're asking to be looking at, let's go back here, compute the break-even point in dollars. Okay. So the contribution margin ratio, the contribution margin is quite small, right? Because you have a $56 product, $42 of that product is in variable costs. So the remaining $14 is your contribution margin. Okay, it's your contribution margin. So when you put that over $56, you're going to have a 25% contribution margin. Okay, ratio. Your break-even sales in terms of dollars, in this case, you have $320,000 of fixed costs divided by the 25% contribution margin ratio. You're going to need $1,280,000 of sales just to break even from this. Okay. B is compute the margin of safety and the margin of safety ratio if the sales are $1,382,400. So we already calculated earlier the 1.28 million. So our margin of safety is simply the difference between the actual sales, right, and the costs that we just figured out, the break even. So $102,400 is the margin of safety expressed in dollars. The margin of safety ratio looks at that compared to the total, right? And so in this case, it's only a 7.4% ratio. The profit is $102,400 on sales of $1,382,400. So 7.4% is our margin of safety ratio. And the last thing is compute the sales dollars required to earn a profit of 410,000. So here we're going to go back to our, I think it's that lovely mathematical formula that you saw, but there's a few ways in which you can do it. Right? In this case, you have the fixed costs plus the expected profit. And you can divide that by the margin of safety ratio. Sorry, the contribution margin of 25%, which means that in order for this company to earn a profit of $410,000, they have to sell over $2.9 million worth of these travel bags. Okay. And that is the deal. So let's go back to our main meeting, see if there's any questions, and we'll wrap up.